Today we're going to talk about wealth creation for Medifast. When I talk about wealth creation, what I'm really looking at is what is this company doing with the profits? So a company, we look at debt, we look at dividends, we look at operations, and we look at an overview of the company. But at the end of the day, as the owners of the company, we want to know what is it doing with the profits? How is it returning those profits to us, the owner of the company, as wealth? And so that's really what we look at with the wealth creation section of the speech. And I think it's the most important part of our analysis of a company. I haven't talked about this much, but I've set up a Twitter account. That's at Robinson Stocks. I set that account up because it takes a few days from the time I decide to buy a stock to the time that I can get a video made and posted on YouTube. So if you want real-time information on my trades, if you want updates on when new videos are posted, and or you want news and thoughts on the market or stocks in our portfolio, then go ahead and follow me on Twitter. Also, please subscribe, like, and comment. It all helps as I'm trying to grow the community. Finally, if you have comments or thoughts on any of these things, I am interested. I'm not just trying to have a monologue. I'd like to have a dialogue with people. So feel free to give me your comments. I'd love to hear what you have to say. Thanks. So one thing a company can do with its profits is they can buy back shares. So here you can see the number of shares outstanding, and you can see that in 2009, the company started to buy back shares. However, it hasn't really bought back any shares since 2014. Over that time, they bought back about 10% of the company from its peak. But you can see that from 1999 through about 2010, they actually were selling shares every year. We hate when companies sell shares. However, it's been a long time since that happened. So long story short, the company's bought back some shares, not a lot, not enough for this to be a significant reason to buy the company, but it is one of the things the company's doing which has returned some modicum of wealth to us, the shareholders. So looking at the stock they bought back through a different prism, if you own 10% of Medifast stock at the end of 2008, you would have owned about 1.3 million shares of stock. Today, through repurchases, your 1.3 million shares of stock would mean your ownership in the company has increased from 10% to 10.98%, or let's call it a 10% increase over time. So you'd own a little bit more of the company. And you would have done that without investing any more money, and you would have gotten dividends, et cetera, et cetera. So if you look at it more importantly, though, your share of the company's earnings, so if you owned 10% of the company's earnings in 2008, that 10% would have been worth about $1.1 million. Today, that same 10% is worth $6.1 million. So about a six-fold increase in the amount of earnings that your shares have created, and that you've got a percentage of. I call those owner earnings. So that's a fantastic return for us as a shareholder, and that's one of the reasons why we like this company. So shareholders' equity, you can see, has basically gone up and to the right. We like that. Shareholders' equity isn't all important, but it is showing that the company is increasing in value. And this is total shareholders' equity, not shareholders' equity per share, but you know that there's only been a 10% change in the number of shares from an earlier slide. So you can see that shareholders' equity has gone up, and in fact, the shareholders' equity per share has gone up even more dramatically, about 10% steeper. So long story short, shareholders' equity is great and is a reason to continue liking the company. This slide, return on assets, is a very, very important slide, and it's a reason that I really like this company. Return on assets, the idea is a company has to tie up a certain amount of assets to produce profits, right? They need computers, and they need hardware, and they need factory equipment, and whatever else a company needs to run. Those are assets the company uses. Sometimes they have to use cash to buy inventory, et cetera, et cetera. So as the owners of the company, we need to know what kind of return on investment the company, or kind of return on assets the company is getting. And this company is doing fantastic. It's always in the top 10% of companies, and the last 2 or 3 years it's gone up even more dramatically. So high return on assets is something that we really look for in a company, because it means that it doesn't need to employ a lot of money to make profit, and the more money it employs, the more money it makes us. So we don't mind when the company retains earnings when they have great return on assets, and we don't mind when the company holds cash when they have great return on assets. So return on equity is also an important measure, but it's not as important for companies that don't have debt. If a company has debt, then they're leveraging up their equity, right? Return on assets is the return on the total amount of money that the company is employing. Return on equity is the return of the total amount of money minus the total amount of debt. And so when a company has no debt, return on equity and return on assets are about the same. And the problem is that it's harder to be in the top performing companies when some companies are really levering up their balance sheet. They're really increasing the risk to get a better return on equity. this company hasn't taken any risk and is still getting a very good return on equity. So even though they're only in the top 25% until the last year where they went up dramatically, I don't grade down for that because they have no debt, and to me that's a big enough asset. So they're not in the top 10% of return on equity, they are in the top 10% of return on assets, and because they have no debt, they get a pass on this. So this is a good chart for this company. So retained earnings is a measure of the amount of the company's profits that they are reinvesting in the company to keep the company going. Now, the important thing to keep in mind here is that retained earnings annualized every year have been virtually flat since 2010. So the company made more and more money every year since 2010, but yet has retained about the same amount of money during that period of time. That tells you this company's being very, very efficient with the money that they're retaining. And as an investor, we really like companies that don't require a lot of retained capital to be profitable, because the money that they're not retaining is money that they can pay back to us in the form of dividends, or in the form of paying back debt, or in the form of any other things that they can do to enrich the stockholders. So this chart is very, very good. Even though you see the retained earnings total going up dramatically, on a year-by-year basis, it's been pretty flat, and we really, really like that. So here's a chart that I've been working on and analyzing, and I'm not sure yet how much I like it. I actually kind of want to get some feedback from you guys. This is a look at the cumulative wealth created during the last 5 years for the company. My thinking is that when a company has a profit, there's only so many things they can do with that profit. One of the things they can do is use it for retained earnings. That's already been discussed. They retain some earnings, they get good return on investment for the retained earnings. The next thing they can do is pay off debt. Well, this company doesn't really have any debt, so they haven't paid off much debt because there hasn't been any. The next thing they can do is they can hoard the cash, right? So they can use the money to increase their cash. We've talked, this company's gone from cash of virtually nothing to something like $120 million in cash. Well, that increase in cash is a benefit to us, the owners of the company. It's increasing the value of the company. Consider that if the company was to be purchased in a buyout, you would get at least a 1-for-1 return for every dollar the company hoarded in cash. There's no way you'd get less than that. And plus, increases in cash means you're probably going to get better interest rates when you borrow money, et cetera, et cetera. So a company having a lot of cash is not a problem. It does increase the value of our business, at least dollar for dollar. They can pay us that money in dividends, and in so doing, they directly enrich us, and they do it in the immediate term versus making us wait for it. Another thing they can do is buy back stock. The purposes of a company buying back stock from a shareholder point of view is that means I own a larger percentage of the company, even though I didn't invest more money, and in theory, I would get ever larger returns on profits. So those are the things the company can do with their money. So what I've done is I've tried to add, to total those numbers and say, over the last 5 years, how much money has this company created in wealth for us? And so you can see that this company is saving more and more money, creating more and more wealth for us, the shareholders. I'm not sure yet what exactly I want to determine from this, other than just seeing these numbers to get a sense for it. For example, I'm not sure that you can say, hey, this company's created $140 million worth of wealth in the last 5 years. Therefore, you should conclude that something's going to happen. The company's going to be doubling in value or something. But I do think it's a good sense for the job the management is doing in terms of taking care of the shareholders. So maybe it's a measure of past performance rather than what's going to happen. But I do think it's something worth looking at and something to keep track of. And I'm going to do this on every company and see what I can determine. My hope is that when I see companies that don't do well here, I'll also see those companies that aren't performing well in the market. And when I see companies that are performing well here, then we'll see that that reflects in the stock price. And so hopefully I can start to say and predict that this is a good predictor of value. I'm not prepared to say that yet, though. So this is a chart of the companies that we have bought since February 7th of 2019, and that we have then held. The company's gone up a significant value, and I have sold the company. You can see that we have the date the stock was purchased, the date that it was sold, the number of days that we owned it. You can see the amount that we invested, the purchase price that we bought it at, the number of shares we bought, the the sold price for the stock, how much dividends we earned, the return on investment, the profits, annualized return, et cetera, and sort of where I thought we would sell the company when I bought it. So this is a good little list, right? So we bought 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So 12 different stocks that we bought have gone up. somewhere between 15 and, I guess one stock went up 9%, but most of the stocks have gone up somewhere between 15 and 35%. None of them have been even owned for a year. So I'm pretty happy with his numbers. This is why we're doing all this research. We find companies that are undervalued and we hold them, and the market, in many cases, in a very short period of time, sees that value. I think since the last time I posted on Miller Industries, we've had 3 stocks that we sold. We sold Pets, which we had purchased at $17.47 a share. We sold it at $22 a share. That's a 35% return on investment. We'd only owned it for 142 days, so it works out to about an 89% compounded annualized return. We sold Manpower Group, which we owned only for 70 days. Bought it at $80.50, sold it at $92. It's a 15% return on investment, 78% annualized return because we'd only owned it for 70 days. And then Miller, the last company we suggested you should buy, which is this great little tow truck company that I found with a $400 million market cap or something. We only owned it for 33 days. We bought it at $32.18. We sold it a month later at $37.19, which is a 15.25% return. Annualized, because we own it for such a short period of time, would be $168. So one of the things that bums me out about that is hardly anybody watched those videos. No, I get a lot better viewing on companies when I analyze them, and it's Fortune 500 companies. Phillips 66 and Altria and those kinds of companies get Apple. Those kinds of companies tend to get a lot of views, and these companies no one's ever heard of tend to perform less well in terms of people watching me. But if you look at these, the smaller companies are the ones that seem to be performing well. So I wish you guys would all watch all of these videos. But here you can see my current portfolio. We own Argan, we own Altria Group, which we have bought at 2 different times, Waddell & Reed, LyondellBasell, we own the Walt Disney Company, Snap-on, we own MCS, Industrial Direct, Robert Half, H&R Block, Gilead, and obviously we just bought Medifast. Generally, when you add up everything for our stocks, for the current portfolio, we're not up a lot. But remember, we've had whatever it was, 12 or 14 stocks that we've bought that we've sold. We're up over 30% so far for the year. I don't know exactly the number. Obviously, it fluctuates every day. I'm not going to worry about that until February. In February, I'll give you a 1-year report. But as it stands today, we're up about 30%, significantly outperforming the S&P 500 since February 7th. So that's what we've done. Thank you very much for watching. I appreciate your time. Please remember to like and/or subscribe.